Greetings and welcome to another installment of Viewpoints by Hennessy. My name is Elliot Bishop, portfolio strategist at Hennessy Funds, and I'm joined today by one of our portfolio managers on the Hennessy Focus Fund, Brian Macauley. Brian, thank you for joining me today.
Nice to be here, Elliot.
So just do me a favor here at the start, if you wouldn't mind, for some of our viewers who are newer to your portfolio, could you just provide a little bit of your kind of elevator pitch for how you guys manage the strategy?
Sure, love to do so. It is the Hennessy Focus Fund. As the name suggests, it is a focused strategy. To us, that means we typically own about 20 to 25 positions. We have somewhere between 60 and 80% of assets in the top 10 positions. So the strategy is focused. I think another distinguishing trait is it's also very long-term oriented. So we have an average holding period of 8 or 9 years. So maybe 12%, 14% average annual turnover. That means we're making 1 or 2 new investments per year on average. And there's some magic in combining that concentration, the long-term orientation. It just means we could be very selective in the types of businesses we own. We could conduct thorough fundamental research on those businesses, and we could look for really attractive entry points to buy those positions.
Great. And so recently, Morningstar released an article calling you guys the second best performing fund in the last 25 years. So first off, congratulations. Those are fantastic kudos.
Thank you.
But do me a favor, because some of the other focused funds in the market haven't fared quite as well over the long term as you guys. How has your conviction-weighted approach really led to some of those results?
Being concentrated is not the same as being concentrated and long-term oriented. And so we maintain this very high standard for the quality of businesses that we're putting into the portfolio. And we focus all of our research time and attention really understanding the business fundamentals and only investing in those positions where we think that there's a very good likelihood of excellent long-term returns, but importantly, very low risk of negative returns over time. And so just striking the right balance of risk and return applied to the very highest quality of businesses is what we think has been our secret to success.
And then, one trend that I think a lot of folks are following is the fact that market leadership this year has really moved away from kind of the mega cap tech names, some of the Mag 7 names, et cetera.
Mm-hmm.
Talk a little bit about how that's opened up some opportunities for you folks within the portfolio.
Yes, it has been helpful. We've seen signs of life, let's say, in the small cap space. The Russell 2000 is having a decent performance year this year. We're always focused on the businesses and how the businesses are doing. And there are lots of companies out there that are producing great growth, great earnings, but they're not part of the Mag 7. And so that's where our opportunity lies. We don't own the Mag 7 in the fund. And so we're looking for these, little pockets of opportunity where others aren't paying quite as much attention. And so it's nice to see some of those businesses that we own get a stronger bid in a market like that and see the fundamentals of the business and the prices of the stock both moving in the right direction.
And then geopolitically, some of the events overseas, talk to me a little bit about the kind of some of the impacts that you're watching on the portfolio.
Well, we are very bottoms up in our approach, really trying to underwrite the individual businesses. We don't spend a lot of time or mental cycles thinking about where we are in politics or the macroeconomic environment. Where we spend our time is understanding those businesses. Yes, we do think through, okay, what would happen to this individual business if we had very high gas prices, if we had particular shortages, if we go through a recession. When we underwrite and own a business, we want to make sure we understand what scenarios like those might look like so we can make sure that we're owning businesses that can survive some difficult times if they need to, and hopefully even take advantage of those difficult times to gain market share, introduce new products, open new locations, and come out the other side stronger. And so we're not particularly concerned in how we manage the portfolio about the geopolitical concern of the day. We're just really focused on that long term.
And AST SpaceMobile, obviously the largest holding in the fund currently. What's been their current role in the U.S. defense strategy?
Yeah, so AST's primary market is in commercial connectivity, providing mobile service to your phone or your device from space to that device. But a nice benefit of the novel technology they've created to serve that consumer commercial market is that they have very unique capabilities in their satellites that has heretofore not been available. And so the US military, intelligence agencies are able to take that technology and use it to do very unique things, many of which we are not privy to, but we know are going on. And so AST is going to play an important role in Golden Dome, in missile defense, in drone defense and drone warfare, in intelligence gathering, in troop tracking, in troop communications, all functions that were not nearly as robust or capable before AST's arrival. And so they're going to play an important role in that world going forward.
And then what in today's market kind of supports but also challenges prospects for long-term compounders in your portfolio?
Well, I think that long-term compounders, which are what we are going out every day trying to populate this portfolio with, they are businesses that are strong enough to continue to make forward progress regardless of the economic environment, regardless of the interest rate environment. They're able to grow through organic growth. They're able to grow through acquisition. They're able to grow through innovation and geographic expansion. And so they are impacted by what's going on, in interest rates or fuel prices, but they have a strong enough tailwind to what they're doing to be able to push through those challenges and still make forward progress.
So, Brian, I know earlier in the year, you and your colleagues added to your holdings in Altus Group and Brookfield Asset Management. Do you mind talking to me a little bit about those trades and what it is that you like about those two companies?
Yes, the market presented us a great opportunity to add to those positions in the first quarter. The stocks both sold off because of concern around software and the AI threat to software. And we used that as an opportunity to add to these positions because we don't believe that these companies are impacted in any important way by those broader concerns. We added to Altus because Altus is a terrific franchise serving the commercial real estate market. It is the leading solution for commercial real estate valuations. It is a tool that analysts and CRE firms use on a daily basis. They use it to communicate with other people in the industry about transactions, and it becomes the essential language for large $100 million, $300 million commercial transactions that would be very difficult to conduct otherwise. In addition, they've got proprietary data, and they have a variety of intelligence tools that are helpful to those firms. And so we believe that AI is not a threat. In fact, it's an opportunity for this entrenched business to be able to add more features and make their solutions more valuable. In the case of Brookfield Asset Management, Brookfield is an alternative asset manager, very large with more than $1 trillion of assets under management. They manage a private credit portfolio as well within their portfolio. And Brookfield and their peers, such as Blackstone, KKR, and Apollo, have come under some pressure because people are concerned about software exposure within private credit portfolios. Brookfield has less than 1% of their private credit portfolio exposed to software. And so it's really a non-issue for them. And in fact, with yields going up on private credit and credit getting a little bit tighter because of these circumstances, it actually becomes an opportunity for them to put more capital to work at more attractive terms.
And then to kind of wrap things up here, I have to say that I have advisors ask me from time to time about this portfolio and this strategy. And they ask, is this more of a kind of a core holding in a portfolio, or do you see it more as like a satellite or an addition? What are your thoughts there as folks think about implementation?
Yes, we see clients use the strategy in both ways. We speak with clients that use the Focus Fund as a, a mid-cap allocation. And so it's part of a core, so to speak. Alternatively, we see managers that use it as a satellite. They want somebody that is an active stock picker, as we are, that's trying to put their very best ideas onto the field, into the portfolio, so to speak. And so they use it as a complement to what they do in their core traditional style box focus.
Fantastic. Well, so as always, Brian, thank you for taking some time to join me today. And for any of our viewers that would like more information about the Hennessy Focus Fund or any of our other investment strategies, please visit us on the web at hennessyfunds.com. Thanks to everybody and have a great afternoon.